welcome to Talking Stocks. I'm Gugulethu, Cele. Also in studio, I'm joined by Peter Armitage and Brian Wright from Anchor Capital. Now, they are the experts, and together we bring you insightful analysis to not only JSE but also globally listed companies. Today, we're looking at a Swiss multinational food company that has interests all over the world. It is considered the largest food company by revenue, producing, amongst many other things, family favorite Milo. You guessed it, we're talking about Nestle. Good to have you with us, gentlemen. Maybe if we can unpack Nestle as a whole overall. We mentioned one of the brands there being Milo, but I guess South African consumers have a lot more contact with this company than they thought.
Very much so. This is a global business with over 2,000 different brands. We can pick out a couple. You mentioned Milo. You're looking at Kit Kats, Maggie Soup, water, Nestle water. So literally every single part of pretty much most consumers will interact with Nestle on a daily basis. They themselves say that over 1 billion Nestle products are sold globally every day. Yeah, it's a very big business, global business, strong business, quality business, and in everybody's lives in every way.
It almost makes sense because everybody touches it in some way or other, so clearly does make a perfect point as an investment overall. But the metrics and the share price, has the performance always seen a consistent move?
This is one of those businesses that they've been delivering on a regular basis. They're not a flashy company. They're not doing 30-40% growth every year. They are a quality banker. They are putting forward 5 to 10% growth through the business on a constant basis. They have the ability to reach a variety of different markets, and we have seen the share price move upwards in a pretty slow and steady fashion for the last couple of years. I mean, if we look at the slide from over that red line perspective, that's about a 50% move. So it's not a company that today is 5 Rand and tomorrow's 25 Rand. This is a business that just continues to deliver to shareholders, continue to deliver the returns, the revenue, the earnings, and as I say, a quality banker of a business.
Peter, is that what you want in the long term, a positive dividend payer in the long term?
Yeah, I think one's got to look at what you're looking for in a company. So at Anchor Capital, we build up a segregated portfolio of global shares, and we always like to have at least sort of 50% in good quality multinational businesses. And Nestle is right up near the top. Another one that we've liked over time is Unilever. The last time I counted, I had 14 Unilever products in my house, and Nestle is fairly similar. My kids will eat the cereal in the morning, my dogs will eat the food. 7% of their business is water. I always find that amazing. 7%.
Well, okay, that's quite a large number.
So, but you go 7, not 70.
Okay.
But you go back and look at 15 years ago. If you said 7% of your sales would be water, you'd be laughing at that. So they've shown an ability to continue innovating. And I think with these big global multinationals, what you've got to look at is they've got great penetration, but if they don't do anything clever, they're going to grow their volumes at 2 to 3% per year. Whereas Nestle has been able to be a step above those. How have they done that? One, because just under half of their sales are emerging markets where there's more natural growth and getting penetration, but they've also been a great innovator. And they've been able to add that little bit extra. The example that viewers will probably experience the most is Nespresso. Again, that wasn't something that existed 10 years ago. Today, our family catches the Gautrain into Sandton City to go and buy coffee pods. I mean, it sounds absurd at a huge premium. So this company is kind of hitting that 5 to 7% volume growth per year, as opposed to the kind of normalized, the Unilevers and the like are doing that sort of 2, 3, 4. And that little bit of extra enables you to grow your earnings a bit faster. So they can probably grow at 10 to 12%, whereas some of the other big multinationals are probably growing at 7 to 8%. But ultimately, the value of a business over time is going to follow its earnings growth. So, in this company, you can probably bank 10-odd% earnings growth in hard currency per year, plus your dividend. If you offer me 12 to 13% in euros or dollars over a 5-year period with relatively little risk, I'm certainly not going to stop eating my Nestle chocolates, Gugu.
Exactly.
With very little risk, that's a very nice equation to be invested in.
I like that emerging markets as well as a developed economy split there. And is that something that holds them in good stead going forward? Because not only are they maintaining the innovations that they want to develop for the developing economies, but emerging markets still need some of the basics.
Very much so. And Nestle really is positioned on both sides, the basic everyday product as well as the premium brands, so they can appeal to everybody. They were first into Europe, first into the US. Now they're moving aggressively into the emerging markets where this consumer is coming through. The person who now no longer had no exposure to powdered infant milk has the ability to go and buy this product. And this is gaining a lot of traction. Africa specifically has been a big contributor into Nestle. China, another emerging market for them. It's growing steadily. It's a small portion, but this is areas where they have the ability to continue to go. And they have products that everybody uses. Everybody wants a cup of coffee. Everybody's going to give their dog food. They're going to give their child infant milk. So again, they've got all these products that regardless of where you are in the world, you need. So I think it's going to be a big driver for them going forward.
For a company that's this big though, are they able to be flexible, especially when it comes to acquisitions and looking for new bolt-on areas that they can expand upon?
Yeah, so it's a $240 billion company. So it's a big business. So to give you a feeling, Apple's north of 600 billion, Amazon and the Facebooks are around the 200 billion, to kind of put it in the context of the world. So no, and that's why they can't grow at 40, 50%, but they can always add on another 2 or 3% volume every year by some acquisitions. But really, if you boil down to what this business is about, is in a lot of instances they're selling you a commodity product that you can buy in a lot of other places, but their brand enables them to get a nice margin and premium on it. Why you would want to pay intuitively more for Nestle water than Joe Blogg's water, but that's human behavior. People are prepared to pay for that. You'll pay more for a Nestle ice cream than somebody who doesn't have the brand. So that they've got commodity products packaged well, delivered well, and the great value in a lot of these businesses is just the distribution network. You can't replicate. People can compete in little territories, but if you're selling 1 billion products a day, effectively you've got a distribution machine around the world, and that's you've got to kind of got your claws around the world, and that ain't going anywhere. So it's a safe business to own. It's a reasonable valuation. It's not cheap. I mean, it's done very nicely in our portfolios in the last year or so. But it's, if you're going to start a new portfolio and you're going to choose 10 kind of core bellwethers, which you think these are the shares I'll probably own for 10 years, this would be a very strong contender to be one of those.
You mentioned that it's not cheap, and maybe that brings us to its PE ratio.
Before we go into that, I just want to touch one thing on what Pete said, specifically around the company and the acquisitions. It's not necessarily one of their key drivers. They innovate. This is an innovative business. They saw Starbucks with a coffee. They brought an espresso to the market. It is now over $1 billion brand per year. They have 29 of these brands that earn more than $1 billion a year. That was their fastest growing one ever. So this is an innovative business as well. So just to put that onto the table, from an earnings perspective, it currently is in a little bit of an expensive territory. We can see it's trading above its long-term average. However, we are seeing this growth coming through. And in the global scheme of things, you are paying up a little bit for that growth. It might not be the 30% growth, but you're getting 5-10% growth, plus your dividend, as Pete mentioned a little bit earlier, 15% total return on an annual basis. We can see that actually coming down to a reasonable pricing level on an earnings multiple basis in the next 2 to 3 years. So although it's currently quite expensive, it's definitely a company to have in a portfolio, to hold through the long term, and the opportunities to buy it on the dips from a price perspective.
But Gugu, to put that in context, to put some numbers to it, its average P multiple over the last 20 years is 20, and it's trading on a forward 21 multiple. So it's there and thereabouts. And I think that's the kind of equation you're seeing across global markets with quality businesses. The stock market isn't expensive. It's average or a little bit above average. So you're not paying over the odds for this business compared to, it's intrinsically worth that kind of multiple. So that 20 multiple is probably going to be sustained over the course of the next 10 years. So the return you get will be earnings growth plus dividends. I think that's the way to look at it. So you say, what do you expect from the market? What do you want from a share? It's always three things. It's what happens to your PE, your earnings and your dividends. So we think the PE is reasonable. It's a reasonable PE for the next 10 years. So you're left with earnings and dividends, and we think that together can give you 10% plus.
And just to, if we also look at that in the global context, Nestle at the moment is trading at about a 25% premium on an earnings basis to the MSCI World Index. The rest of its peer group is between 35 and 40%.
Sure.
So it is an expensive sector, but this one in context is really attractive.
Attractive, that's the key word we want to hear, because now we go to our next segment, which is buy, hold, sell, to pick our experts' brains as to what their view is on this particular stock. Brian, buy, hold, sell on Nestle?
Very much a buyer of the stock. It's innovative, it's moving forward, it's in the right markets, right products, and above all, it's a quality business. So I would be a buyer of the counter.
You agree with this as well, because you mentioned that it is what? A bellwether.
Yeah, so I think I'd add another word to it. It's not a buy to trade. The share price might be the same in 6 months' time, but that's not how we invest. It's a buy and hold. It's a company you can put in your portfolio, and every time you eat the ice cream or the chocolate, you can be comforted that you're profiting a little yourself.
Just to close off on that note, macroeconomic conditions, sluggish growth, and what we're seeing in the overall global economy, does that play any impact on this company's books?
When I'm feeling poor, I eat more ice cream. So it's yeah, no, but it sells staple stuff, so people don't stop buying a lot of the stuff that they produce. But in great economic conditions, they will do better. But when things are really tough, they just won't grow as fast.
The basics will still be bought.
Yeah.
And ice cream. Well, we'll leave it on that note. That's all we have time for Talking Stocks today. As you heard, it's a buy for Nestle from our experts. But do join us again next time where we talk more stocks.